Good afternoon. This is Sean Golding here to discuss a little bit about the basics of FBAR and foreign account reporting and tax compliance. The reason this is so important right now is because recently in early July, the IRS did away with the delinquent FBAR submission procedure. Seemingly, it still exists in the Internal Revenue Manual, but they don't update the Internal Revenue Manual as quickly as they update the website, right? The website basically says there's no more delinquent FBAR submission, and they did this by just removing all they did was remove the web page, and then they updated other content on their website. So when it comes to individuals having to report, because remember, it could be entities and trusts as well. U.S. person, the definition doesn't mean just individuals, but here we focus on individuals. U.S. citizen, lawful permanent resident, foreign nationals who meet the substantial presence test. Of course, there's exceptions, exclusions, limitations, certain court cases, etc., but that's the baseline. In general, you have to report things like foreign accounts, assets, and investments. It's not limited to just bank accounts, depending on what form and if you meet the threshold. You have to file it whether you live in the U.S. and abroad. There's various different threshold requirements. The most common one is the FBAR with a $10,000 or more than $10,000 an annual aggregate total on any day of the year. If you fall into any of these categories and you have these type of assets and you meet the threshold, then you may have to report certain accounts, assets, and investments on various international information reporting forms. Let's go a little bit into what's reportable. So bank accounts are reportable. Most people know that. Current account, savings account, checking account. Security accounts are reportable for equities, for funds. Like a bond fund would presumably be reportable, whereas an individual bond may be reportable for some forms and not others. Life insurance policies that have a surrender value, so it's got a $100,000 face value. You paid 10 years of premiums. You want to cancel the policy. The company's going to give you $20,000 back. The surrender cash value is $20,000. Then entities, partnerships. There's various complicated forms you may have to file. 5471, 8865, 3520A as an atom. Now, once you have a grasp over what kind of accounts, assets, and investments you have, then you have to kind of see the different forms. So the ones you'll see the most common referred to is the FBAR, which is FinCEN Form 114, not technically a tax form, but enforced by the IRS, and FATCA, which is the Foreign Account Tax Compliance Act, Form 8938. That is a recent addition in 2012 for the 2011 tax returns. FBAR has been around since the 1970s. But only since 2001 or 2003, I forget, did the IRS begin having enforcement. That's more basic because for those forms, primarily you're reporting the maximum value. But then there's other forms you have to file as well, and they begin to get complicated. PFIC is Passive Foreign Investment Company. There's lots of different types of PFICs, but for most individuals who are not intending to form a foreign passive company, corporation, it's mutual funds, ETFs, CCOVs, unit trusts. Those will typically fall into the PFIC moniker, depending on whether you have excess distributions, whether you redeemed or sold or switched out, will impact how complicated or not the reporting is. Things like foreign gifts, trusts, inheritance, reportable on Form 3520, not a tax form per se because you don't have to have any income. The trust may have income, but most people file it because they received like a gift or an inheritance from a non-resident alien. There's also 3520A, which is U.S. owner of foreign trust. That's much more complicated than reporting a foreign gift. And then if you own a foreign trust, you also have to file 3520 in a more complicated fashion than if you're reporting receipt of a foreign gift or inheritance. Foreign income in general. The U.S. follows a worldwide income tax model, which means all of your income is taxable, whether it's sourced in the U.S. or abroad, whether you live in the U.S. or abroad. Now, if you paid foreign taxes, you may qualify for foreign tax credits. You may qualify for the foreign earned income exclusion. You may make a treaty election to be treated as a non-resident alien for tax purposes, which may minimize your non-U.S. source tax implications. But from a baseline perspective, just know it's a worldwide income. It's called citizenship-based taxation, but it's not just citizens. It's any of those three categories we discussed earlier. U.S. citizen, lawful permanent resident, foreign national who meets a substantial presence test. If you're out of compliance and you want to get into compliance, we have a ton of free information available on our main website and our sub-websites. You can go over the different amnesty programs. There's the streamlined procedures, delinquency procedures, reasonable cause, and VDP, voluntary disclosure, if you're willful. The IRS recently did away, seemingly, with the delinquent FBAR submission procedure, so the other delinquency procedure still exists, DIIRSP, but it's not as forgiving as the delinquent FBAR submission procedures. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.